If you invest in private equity, syndications, venture capital, or even just own a fractional share of a business, you know the annual ritual, the Schedule K1. It's the critical document that reports your share of income and losses from partnerships and S corps to you and to the IRS. Here's the problem. The K1 is not a 1099. It's not a simple one-line entry. It's a roadmap. And if you miss a turn reporting it on Schedule E, you could leave thousands in deductions on the table, or worse, trigger an IRS letter for a disallowed loss. In this video, we're going to master the 2 pages of Schedule E and, more importantly, the 3 gates your K1 losses must pass through. Your Schedule K1 has 20 boxes, but for tax preparation, we focus on the core income fields that flow to Schedule E, page 2. Box 1, ordinary business income or loss. This is the core operating result of the partnership or S corp. For most investors, this lands on Schedule E, Part 2 or 3, line 28 in column I or K. This income is generally subject to the 3.8% net investment income tax, if your modified adjusted gross income is high enough. Box 2, net rental real estate income or loss. This is for your share of rental activity. Think real estate syndications. This also lands on Schedule E, line 28, but is treated differently because virtually all rental activity is considered passive. Now, don't forget that many K1 items go elsewhere. Dividends, which is box 6, go to Schedule B. Capital gains, which is box 8 and 9, go to Schedule D. Always check the instructions if you're confused. The biggest mistake you can make with a K1 is simply taking the total K1 loss and inputting it directly. You can't do that. You first have to pass the 3 loss limitation gates. Now, before you can claim a loss from box 1 or 2 on your K1, you must pass through all 3 of these gates, these successive tests essentially. If you fail a test, your loss is suspended and carried forward. You do not lose it, but you cannot deduct it this year. Gate 1, the basis limitation, which is basically your investment. The rule here is you can never deduct a loss that is greater than your basis, which is your actual investment in the business or partnership. I put in $100, I can't have a $120 loss. Not possible. So you, the partner, are responsible for tracking your basis, not the entity. If your loss is $100,000, but your basis is only $70,000, you can only deduct $70,000 this year. The remaining $30,000 is suspended until you increase your basis by making another capital contribution. Is essentially how you increase your basis. Gate number 2, the at-risk limitation, Form 6198. The rule here is your loss is limited to the amount of investment for which you are considered at risk. This generally means funds you personally invested or loans you are personally liable for at risk. Non-recourse loans where only the property is collateral are generally not at risk, with a major exception for qualified non-recourse real estate financing. Compliance aspect here. This requires filing Form 6198 at-risk limitations. If you're a high net worth investor with complex debt structures, this form is essential. Gate number 3, the passive activity loss limitations, which is on Form 8582. The rule here is this is the most common reason for a disallowed loss. If an activity is passive, meaning you do not materially participate, the loss can only be deducted against passive income. Crucial exception for rentals. All rental activities, box 2 income, are automatically passive, even if you put in a lot of work, unless you qualify as a real estate professional. Passive activity loss limitations are calculated on Form 8582. If you have a $50,000 passive loss, but only $20,000 in passive income from other sources, you can only deduct $20,000. The remaining $30,000 is suspended, like me in junior high, until you have future passive income or fully dispose of the activity. The Schedule K1 is not a simple tax form. Your ability to claim losses comes down to accurately navigating the basis, at risk, and passive activity rules, all of which are summarized and reconciled on Schedule E. If you have multiple K1s, substantial passive losses, or are claiming real estate professional status, do not risk an audit or leave money on the table. Let a professional handle it.
Hey, my name is Arash. I help people create plans to pay less in taxes. Did you know if you like, subscribe, and comment on my videos, you will automatically save 10% in taxes? Okay, that's actually not true. Also, I need to let you know that none of this video should be taken as tax advice. However, I would love to give you individualized tax advice. All you have to do is schedule a consultation on my website, link below.